Good morning and welcome to the Saxo Bank Morning Call. It is Tuesday, May 21st, and we have the latest twists and turns in the trade showdown between the U.S. and China with apparently a clueless U.S. administration not realizing that placing Huawei on the entity list meant that U.S. companies would need to take immediate action to signal that they're in line with these new rules. So we saw, of course, yesterday the semiconductor manufacturers and Google, especially Google, was a lot of focus on that, announcing these new measures that they could not sell their wares and their services to Huawei going forward. And now we get suddenly, a reprieve overnight of 90 days. So apparently, to me, this points a little bit to U.S. administration cluelessness on the immediate impacts of its policy making. But if we look at the chart here, we're seeing that the markets are, not exactly, showing signs of raging confidence on this. We saw a bounce overnight, Peter. Also out in Asia, we saw this bounce, but it's not exactly, retracing everything we saw on the downside yesterday.
No, exactly. Yeah, we are 0.5% higher, but it's we shouldn't retrace for good reasons, because even though this seems like a clueless move, we're still seeing, I think, as I wrote yesterday on Insights, the starting signal of a Cold War in technology, and I think that will go on for decades. It's very clear that if you look at the trade numbers, it's sort of a sideshow. Sorry, it's the technology. It's the U.S. trying to not let China overtake the U.S. too fast.
Yeah. Now on analysis.saxo, you put out a great article yesterday, Peter, on the asking, are we ready for this global potential for a global tech trade war, and looking at some of these big companies and their specific exposure to China.
Yeah, exactly. As you can see here in the table, I highlighted all the companies in the S&P 500 with more than 10% exposure to Greater China. So it's mainland plus Hong Kong. And I sort of highlighted in orange sort of the most high-flying brands that could be hurt if the Chinese wanted to go directly after a company. And I think Apple is probably the one that is the most has the highest likelihood of an attack from China based on what happened to Huawei.
It's an easy hit because it's an end product that can just be eliminated without much effect to Chinese
society,
because you have other companies that
they already have Huawei, so it would not mean a lot. But I think we must give Huawei credit for what they've done. It turns out that they did 12 months of stockpiling of hardware, and they have also in the past year been working on software to replace the Android. So they seem pretty well prepared for what's going on.
I think as well, and one thing leading to maybe a little bit less confidence in markets, if you're looking at the Chinese response to a lot of this, they're clearly drumming up the PR machine with some efforts on the home front in the press to talk about their strength in this situation, and clearly ready to, if they need to take tough measures and sort of suffer a bit of pain to get their point across. We're seeing patriotic songs in the Twitter sphere and in Chinese press. We're seeing all manner of a defiant stance. So this could be interesting to see how the U.S. administration, if they've overstepped their assumptions on how China will respond in all of this. You also pointed out there's also another key sort of PR move in China yesterday was Xi Jinping's visit to a rare earth mineral facility, or a company, I guess it was.
Yeah.
Because this is a big angle where China actually does have a lot of leverage in these talks and in this relationship.
Exactly. So China is by far the biggest producer of rare earth minerals, which are used in electronics and military equipment, from GPS to missile guided systems, etc. Interestingly enough, actually, that even though China is the biggest producer, they are also the biggest importer. So they're not fully supplying their own market. They also dependent, and I think that actually means that Australia is in a very unique position as having one of the biggest deposits of rare earth minerals outside China. Japan potentially also a joker in this game. And if you look at the slides here, from a U.S. perspective, around 78% of imports of rare earth minerals is coming from China. And the U.S. was the biggest producer of rare earth minerals 50 years ago, but it has since declined massively. As you can see here, the U.S. is number 3 after Australia and China by far. And I also put forth that we had this back in September. We did a buy recommendation on Linus, which I've marked in red. The share price was up 15% today. And Linus is the only independent, publicly traded, pure play miner on rare earth minerals. So I think they have to get
a lot of attention.
Very much attention. And they have 10% stake, and they just did a joint venture with Texas, a US-based company in rare earth minerals, doing a processing plant in the US. So I definitely think it's moving on this front.
Yeah, very interesting. Now, Ole, all this talk of the trade showdown, trade volumes decreasing around the world. oil prices, you would think, would be responding to the economic outlook with a bit of fear, but there's a lot of supply concerns. Of course, the U.S.-Iran situation holding the front month up.
Yeah, you nailed it completely. We have a market which is not really going anywhere right now, and we got so many moving parts which could create a major move. But over the last few days, we've seen OPEC Plus meet in Jeddah, and they agreed to maintain these production cuts for the remainder of the year unless it was warranted to increase, i.e. if demand or supply from Iran drops more than expected. But I think you brought a chart here, John, just to give an idea about what's been going on now. This is the spot share month, which is the dotted one, and then we got the brown line, which is the Brent crude 1 year out. And you can see really that it's been struggling to keep up with the rally recently, and that's quite it's basically indicating that as the market goes up, the selling activity from producers increases at the back of the curve, which is keeping the back down, while the front is also where we have all the speculative interest, which is buying it up, but we also got the potential worries about the geopolitical risk events and tightness. So right now we're stuck in this $70 to $75 range. I think the risk right now is that there is a risk that we're going to see the demand growth being revised lower, and obviously that will take some of the further sting out of this bullish momentum that we had up until
certainly. I would suspect at some point, if these global growth concerns are at a sufficient level, we could see quite a gap lower on any kind of breakthrough in geopolitical tensions, etc. Yeah.
Absolutely, and we already last week saw the IEA reduce further their demand growth forecast for this year, so it is starting to move, but the consensus is still higher than where the IEA is.
And an awful lot of that crude oil ends up as motor gasoline, and you're seeing, at least in new car terms, Peter, you've brought some stuff with you about the global car industry. There's been a lot of attention on this, with the volumes really dropping on new car sales.
Yeah, it looks terrible. In all the presentation I've done with clients in Prague and London, I have shown this chart here, which you can see on the slide, where global car sales and China car sales is just plummeting. We're seeing the worst global car sales. That's the green line. Maybe a little bit difficult to see, but that's the January figure is the worst annualized decline in 3 months over 3 months since the financial crisis, and in China even worse. And Ford yesterday announced that they're cutting 10% of their global workforce. It's the Ford share price you have in the chart there. It's almost down 50% over a 5-year period. Very ugly chart, if you ask me. And you have a good point, John, because you mentioned before we went in playing the devil's advocate that there is also a vacuum inside the car industry from this transitioning to electrical vehicles, and that might be true. Although I think the biggest part of the variance that we're seeing, or the downside variance here, is to the fact we have a weak global economy, but definitely the electrical vehicle is also playing a part.
Right. People waiting or holding off on those new car decisions until they can figure out whether there's a good deal or whether they should be waiting for the next tech, the batteries, the longer ranges, etc. All right, let's zoom in on a specific currency story overnight. One of the bigger movers was the Australian dollar back to the downside. We saw the boost to the Aussie over the election results, where we saw the surprise win for the incumbent Liberal National Party or coalition, and that was quickly faded, as we suspected it would, because the underlying issues are still there, and that is that the RBA is set up to cut rates overnight. Governor Lowe indicating that he's ready to cut in June. You see the chart here, how quickly the Aussie is back down here versus the dollar. He's effectively pointing to that June cut and essentially indicating to the government, hey, let's boost that fiscal spending. I'm giving you a chance to do so with lower rates. That could be an interesting support eventually if the government finally does move, and once we work through the worst of the housing downturn, etc. But for now, we're looking at the lows of the cycle. That lower dotted line there is the low. If you don't include that crazy flash crash low from early January, it is the effective low from I can't remember which year prior or since the global financial crisis. So we're getting towards effectively 10-year lows here in Aussie dollar if we continue lower from here, and I think that's one of the few things going there. And interesting that it can progress lower despite this Chinese renminbi, that floor under the renminbi still holding. And I'll talk more about that in a second. One of the things that is supporting the Aussie from a fundamental angle is a strong iron ore price. I want to just bring in really briefly here, Ole, this I think it's an interesting market. Yeah. There was some Bloomberg article about it being the mother of all backwardations. In other words, the spot price is still very high, but then it slopes off very, very steeply. Is that because we have near-term supply pinch and we're going to expecting those supplies to materialize down the road, or what's going on?
Well, I think it's a classic example of a market that can, commodity market, which is depending on the global growth, that can still go up even though there's some worries about growth, because we've seen a perfect storm almost in iron ore. We got demand from China's steel mills right now being very strong, so inventories at the ports in China is coming down. At the same time, we had supply disruptions, most noticeably in Brazil earlier this year, but also from Australia. So supplying being under pressure, at the same time demand is rising from steel mills in China. So perfect storm. So we're back to $100 a ton, and at this stage there are some expectations that this squeeze could continue as stocks in China continues to deplete.
Yeah. And another commodity very much in focus, and we've covered this quite a bit because it's a very interesting story and really critical for global food supplies, if you ask me as well. The corn plantings in the U.S. still behind schedule because of all this incredibly wet weather, and we've really got a huge movement in the chart here.
Yeah, it's again one of these scenarios where it's really important to keep an eye on the weekly speculative data, the COT reports that we send out on Mondays, because it does give an idea about if there is a change in the technical or the fundamental outlook, whether we can expect a major move. And just take a look at this. This is most certainly what we have seen in corn now over the past couple of weeks. These are weekly bars, so we are up 12.4% over the last week and a bit. And the reason for this is over on the top left. The planting progress in the US is now at the slowest pace for this time of year on record. So that's these records goes back to 1980. So with the window of opportunity for planting closing fairly soon, and with weather this coming week indicating further rain and further miserable conditions, it basically means that the acreage for corn and the potential also the yield, with that also the yield will come down. That will obviously help.
Is there a window? Is there a window of time where it simply becomes too late, or they have to plant something else?
It becomes too late, and then that's another reason why something like soybeans is struggling as well, because soybeans a perfect storm of negative news, because we got the African swine fever, we got the trade war with China, both reducing demand, but at the same time, what can farmers do if they abandon corn and wheat? They move to soybeans because they can plant that slightly later.
I see.
So that's one to keep an eye on. But right now the speculative interest is coming down, and it was long overdue. And so far it's primarily probably a short-coming rally.
All right. Finally, on I think markets to watch is, of course, the one market to watch above all else is the Chinese renminbi. It is very slightly stronger overnight after pressing to new lows for the cycle. It's around, I think it was 692 was the highest I saw print yesterday on the dollar CNY rate. Very curious to see whether the Eurodollar, for example, I have a chart here, once again approaching those lows, 111.10, whether it can break lower, as I think it would have done some time ago, were it not for that anchor being provided by the Chinese currency. You can see how the last two lows, I've put those dotted lines in red there, minor lows immediately rejected. One of those was on an ECB dovish meeting that was immediately rejected. Another one further along there in April, and now we're going back there again. I have a hard time deciding. I think it can break lower, but I would have a hard time seeing it beyond 110 to the downside without China moving on its currency. And now that we have this sudden 90-day reprieve in Huawei, I don't know, but I think the risk is we get stuck in this terrible low volatility phase again, unless there's new signs of escalation in the trade war. So I think that's going to be the key. Once again, unfortunately for us all, headline-driven trading. Now let's look at our calendar for the rest of the week. Today, very little out there. A couple central bank speakers, minor data. Maybe keep an eye on New Zealand Q1 retail sales. The relative Aussie-Kiwi rate is getting a bit interesting, as I've covered before. FOMC minutes up tomorrow. And then I think one of the more interesting data points will be those Eurozone flash PMIs. We talked previously about the incredible weakening in European lending. This is a concern, the credit impulse into the European growth in coming months. We have also the U.S. market flash May PMIs as well on Thursday, and then we round out the week with something like U.S. durable goods orders.
I was just thinking actually that, but one thing that could maybe accelerate volatility again is that we talked about it before we went into the studio. The South Korean export numbers for the first 20 days of May shown a decline of 12% year on year. I mean, the South Korean unemployment rate is the highest in 19 years. So you're seeing a lot of weakness coming out of Asia still. So the potential source of volatility is that this discount in the equity price that will have a V recovery in the macro. If that doesn't happen, it becomes almost an L shape. Then we're in for some serious summer months. Actually,
it'd be very interesting anyway to see a shift of narrative. We have this obsessive focus on the trade headlines, and suddenly, whoops! What about fundamental data?
Exactly.
That actually might mean something as well. One final note that we do have, starting in a couple days, these EU parliamentary elections. So we'll be covering that extensively next week. But keep those on your radar as well. Also as something that's potentially holding back the euro here. That's it for today. We'll be back tomorrow with the Saxo Bank Morning Call. Thanks for joining.